Hello, welcome back to The Other Side of Deaf. This is Crystal Hand, your host. Today, we are going to talk about something that is probably an unpopular topic. Not because it's controversial, but because, let's face it, no one likes to actually think about money. We like to have it and spend it, yes, but thinking about saving money or how to prepare in the future, most people try to avoid it, or it's so low on their to-do list, it never really gets done. Now, you may be asking yourself, what do finances have to do with being deaf or hard of hearing? Why would I talk about this on my show? Well, for many parents and caregivers out there that are raising a child that is deaf, finances can be a really big deal, especially if that child is not what we would call, quote, vanilla deaf, meaning deafness is the only diagnosis. You all know that I'm a big believer that deaf can do anything and that hearing loss never holds you back. But what happens when being deaf or hard of hearing isn't the only medical issue? Many parents are dealing with additional concerns like a CMV diagnosis or genetic syndromes like Usher's or Downs, or maybe a child was born premature and has other disabilities. When that happens, parents often have to think not just how to support their child in the present, but also what happens to their child in the future. I often hear from families of children with multiple disabilities that one of the biggest stressors for parents is what happens to my child when I'm gone? How will they support themselves? And how do I make sure they are taken care of? If your child has a large language deprivation, or a disability that doesn't allow them to work full-time in a job that supports them, how do we make sure our children are financially secure? Well, today, my guest is an expert in this field, and he is here to guide us through all of this. James Lange is a CPA and an estate attorney who has been practicing for more than 35 years. Jim is the author of 9 best-selling financial books, including his most recent book, Retire Secure for Parents of a Child with a Disability, which he co-authored with Deborah McFadden and Julianne Steinbacher, all who are experts in this field. Jim and his wife Sydney have a daughter with a disability, and he wrote this book after he figured out the best long-term plan for his daughter's financial security and realized his solution has universal value to most families with a child with a disability. There's a lot to talk about and learn today, so buckle up and let's get started. Hi, James. How are you?
Good. Thank you for having me, Crystal.
Well, thank you for being here. So we're going to dive in because we have a lot to cover today. I'm really excited about having you on here because I think this is a topic that a lot of children with disabilities, their parents don't really dive into. We tend to get overwhelmed with all of the other stuff, the medical and all of the appointments and everything. But this is such an important topic, and it's really, really exciting. So tell me how you got into doing this. You've been a financial advisor, like I said, for 35 years. What made you get so passionate about helping other families with their finances?
Well, for a long time, I didn't specialize in parents with a child with a disability. I was really kind of an IRA guy. So that was kind of my area of expertise. And I wrote books and I built a very successful business, and I still have that business. And then while this is going on, my wife and I are raising our daughter, who always had some problems ever since maybe junior high, but we were always hoping that, well, somehow she's going to be okay. And, so we took her to every specialist that you can imagine. We dragged her all over the country, different places, different modalities, etc. And it became obvious that she would never be able to work. So now the issue was, I'm 67. My wife is roughly my age. Let's say that we have enough money to provide for ourselves and for our daughter for the rest of our lives. Well, she might survive us by 40 years. And this became our biggest worry. What's going to happen to our daughter after we die? So luckily, I had the perfect background to answer that question because I was an IRA guy, and there's things that you can do with IRAs that are much different than other people might do. I was a Roth guy doing Roth conversions. I was an estate attorney. I understood, special needs trusts and other trusts, et cetera, et cetera. So I came up with the solution and we executed it. And it was life changing for us. First, the actual fact of, oh, okay, we figured out a way she's going to be, instead of running out of money, she'll have $1.9 million. And basically, that's a direct transfer from Uncle Sam to our daughter. And that doesn't even include government benefits like SSI or SSDI. So we had this, what I thought was this fabulous solution. We experienced it ourselves. We made the, let's say, conceptual adjustment. And then here's the other side benefit that I kind of didn't realize is our anxiety level went way, way down. All of a sudden, we weren't worried. Oh, well, we're still worried. We're worried about, frankly, some of the non-financial aspects. But the other thing that I didn't know was how worried our daughter was. Here she is, not able to work, with, let's say, sufficient money to live right now, but she kind of didn't really know. She just kind of assumed that I was going to watch after her, but she didn't know that I was working on a plan that would provide her a good income for the rest of her life. And when she found out, her anxiety level went way down. And it's the nature of her condition. And frankly, most of us, if our anxiety goes down, the rest of our health improves. So I was just so happy. And I thought, okay, I want to tell the world about this. And I got working on a book. And I was fortunate enough to have two wonderful co-authors who covered areas that I did not have expertise. And we wrote what I humbly think is the best financial resource for parents of a child with a disability.
Okay, so that is an amazing story. So I love to hear that because I think it's so much more powerful when a professional that has a child with a disability can really understand all of the nuances that goes with it, because it's something completely different than most parents think. And I want to read a quote from the book that just really struck me. And this was in chapter 12. She writes, raising a child with a disability is expensive. Many parents and children have quieter and less spoken concerns. We have examples of what it means to be a parent, but having a child with a disability brings a whole lot of different challenges. And I just thought that that was such a great thing to put in the book, because as financial professionals, all three of you that have co-authored this book, you really have thought this through from a parent's perspective of someone who has a child with a disability. And that's so powerful to kind of be able to relate that. So let's talk about your book a little bit. How did you get connected with your co-authors, and how did that all come together?
Well, the first co-author that I was able to recruit was like the perfect co-author for me. Her name is Debbie McFadden. A real quick story with Debbie and her daughter. Roughly 36 years ago, Debbie, as Commissioner of Disabilities under H.W. Bush, was in Russia on business, and she was visiting an orphanage. And there was a 6-year-old little girl who had spina bifida, didn't have the use of her legs. The orphanage didn't have resources. She got around on her hands. Debbie actually ended up adopting this girl, bringing her back to the U.S., getting her appropriate medical care, getting her a wheelchair. Debbie's a big believer in getting kids with disabilities active and involved in competition, etc. Anyway, her adopted daughter was just beating everybody in races, and now she is a 20-time Paralympic champion, multiple world champions, marathon champions. So it was really wonderful. Debbie knows more about qualifying for SSI and SSDI, which are government benefits, than anyone I know or even can think of. And it so happened that she was a client of mine. And I thought, boy, wouldn't it be wonderful if she was willing to be a co-author and write this section on SSI and SSDI. And, she eventually agreed. That just added so much credibility to the book. Her daughter, this famous Paralympic athlete, Debbie, former commissioner of disabilities, with 400 attorneys working under her. Is that a nightmare or what? Working with 400 attorneys. And then a mutual friend acquaintance recommended that I work with an estate attorney, Julia Steinbacher, who works in this area. And Julie, she's just a wonderful estate attorney. In fact, even though at the time I had a very good law firm, I went to Julie for our legal work because she's a specialist. And as good as the estate attorney that I was working with was or is, he wasn't a specialist. And Julie knew a lot of stuff that most estate attorneys don't know. And the other thing is she actually had social workers on staff, because she knows a lot of times people have not just financial issues. And it was very nice to have one office that had, multiple capabilities. So anyway, we started out with it was a 55-page report, and there was obviously demand for our information. And then we decided to write a book. The book as written is a tremendous resource. And frankly, that is by far the driving force of my professional activity right now, is to get the word out about this book.
Yeah. So I have to say, when you pick up this book, it was very easy to navigate. Oftentimes, financial books, I'm going to be honest, I'm not a financial person. So it's like all Chinese to me, right? But when I picked up your book and you're able to go through the table of contents, and it really says like, okay, let's talk about this or let's talk about that. Go to that chapter. And what I really love about your book is that at the end of every chapter, there is the key points page, which really summarizes like, these are the important things you needed to get out of that chapter. And that was really helpful for somebody who may not, like myself, may not understand all of the things that you said in the chapter, but I can look at that and say, okay, I think I got it. That is really, really helpful. So anybody who might be listening, if you kind of feel like, oh, I'm not sure I'm going to be able to read a financial book, this is something that is probably the easiest financial book to navigate. So just don't have these expectations. It's going to be overwhelming.
Thank you for that. For whatever it's worth, we've always put a ton of time into the table of contents. And because it is so voluminous, the book, and it's so intense, people assume it's AI. Not one word of that is AI. It's all the three co-authors. And we did want to make it accessible. And in fact, if you read nothing other than the summaries at the end of the chapters, that would go a long way.
So let's start diving into what's in this book. So the first thing that you talk about, your 3-step of big things, is Social Security benefits for disabilities. So first of all, let's talk about what's the difference between SSI and SSDI. How does somebody qualify for that?
Okay, just to give people an idea of how important this is, it is mission critical. Qualify for SSI or SSDI. It is the golden ticket. If you only had one thing to do, it's to get your child qualified for SSI or SSDI. All right, so let's talk about the differences in the program. SSI is basically a poverty program. You are very limited by how much money you're allowed to have. You are very limited into how much income you are allowed to earn. So you basically have to be broke. And one of the problems with SSI is that until you turn 18, they're going to, they being the Social Security Administration, they are going to include your parents' income and assets into the test of whether you have too much money. And for the vast majority of people, that will push them over the limit, so they're not going to qualify until the child is 18. So there's other things that we can do, and we can certainly talk about that. But basically, that will delay applying for and qualifying for SSI until the child is 18 years old. But when the child is 18, and you have to plan this right, you can't be giving your child money. You can't have a trust fund that doesn't qualify. There's a lot of things financially you can't do, and you have to prepare for this. But that's typically what most people are going to do. We want to get that child qualified for SSI typically when they are 18. Now, SSDI, on the other hand, it's not a poverty program and it is based on work records. And it might be the work record of the child themselves, although now we're talking about an older child. Maybe they did work for a while and they lost the ability to work. Or in our case, when my wife became old enough to collect Social Security, our daughter is collecting an effect off my wife's working record. And that is more liberal in terms of how much money you're allowed to have, how much income you're allowed to have.
So, what I thought was really interesting in the book, which kind of reframed it for me, was that SSDI is not, and Social Security is not a welfare program, correct?
Correct.
So I think that that's something that I know that I had misconceptions, because in my mind, I was like, well, I don't want my child to live on welfare. I don't want my child to have this kind of mentality. And so you explained that it's not that case, because it's actually based on us putting money in just like us for Social Security benefits.
I feel absolutely compelled to comment on something. You said, well, I don't want my child to be thinking they're collecting welfare. All right. You have to get over that. Everybody listening, you have a long, hard road to hoe from where you are to financial security for yourself and your child, not only for your life, but your child's life. This is very, very difficult. You have to get that head stuff out of your mind. You're going to try to get every single benefit that the government is willing to give you. You're going to take any legal tactic you can to get your child qualified. You're going to do everything, in my opinion, you should be doing everything you can. And you need to take the time. And I know that you're fantastically busy, putting up with the day-to-day problems that you have. You need to do this. It's critical. We have a tough job to provide for our child for what might be 30, 40, 50 years after we're gone. Take advantage of everything.
The other thing that I thought was really interesting in the book was that you talk about when applying for these benefits, you have to take off the hat of my child can do anything, and you have to put on the hat of my child can't. And in the book, you say, if your description to the government doesn't make your mom cry, then you didn't do it correctly. So let's talk about, how do you apply to Social Security?
Which, by the way, we didn't really quantify the benefits, but you're talking, I don't know, somewhere in the ballpark of $8,000-$10,000 a month. But more importantly, you're getting Medicare and you're getting other insurance benefits. You might qualify for vocational rehab. You might qualify for equipment, special computers. There's a lot of benefits available. And there's a couple ways you can do it. One, you can be a do-it-yourselfer. And I think Debbie McFadden did a great job in providing as much information as possible for the do-it-yourselfer. Now, that is Debbie's business. And very frankly, I wish I had known that Debbie did that when we were applying, because it was a grueling process, because it's basically you have to prove to the government, or what it really is, it's going to come down to basically one Social Security Administration employee, that your child can't do all these things, which is what you brought up. You get the doctors to write, the child can't do this, can't do that. You get the teachers, the any caregiver, I can't. So in Debbie McFadden's case, she was applying for SSI for her daughter, who was an above-the-knee amputee world champion, or at least world-class rock climber. All right. Now, that woman, I would bet anything, could go up the steps faster than you or me hopping on one leg. Okay. But did she write that when she was applying? She said no, she cannot walk up a flight of steps like a regular person because she only has one leg. All right. What she can't do, not what she can do.
And that is so hard for parents. As I said before, we don't want to think of our child not being able to do something. So having that kind of concept of being able to take that hat off and say, okay, we got to change our mindset for this application. That's really, really hard. But you're saying it's an important step that we have to get over. We have to be able to do this.
And we have to emphasize all the things that we wish were different. So when we were talking before we got on, you said, well, a lot of the people that do qualify not only have a hearing impairment, but they have other problems. Well, lay it on them, tell them about all the other problems and any cognitive problems, anything that would keep somebody from working. Again, I'm not saying to lie, but you want to put it in the worst light for your child that they can't do all these things, because this is going to make such an important difference. So if you're do-it-yourselfer, I think Debbie did a great job in describing that. Now, that said, if you can't afford Debbie's fee or somebody who works in that area, I think her value is just so great. But whether it's Debbie or somebody else, finding somebody to help. We didn't. We did the application on our own. And my wife spent hundreds, if not thousands of hours putting everything together. And we were denied. And we did get an attorney to help us with the appeal, but the attorney, frankly, wasn't all that helpful. And it was my wife's dogged determination and, going to all the doctors, because we want lots of third-party evidence. And doctors and teachers and people who know your child are the best. And we finally got the notice that we did qualify.
So let's switch gears. So talk to me about ABLE accounts. So what are they and how do they work and why should parents have them?
All right, ABLE accounts are wonderful. And I'll start with what might be the most accessible description of it. You know how sometimes you're trying a new food and somebody says, well, it tastes like chicken. And you're, oh, okay, now I know. Well, the ABLE account is like the 529 plan for parents of a child with a disability or even the child themselves. But what it really is, it's either you or an other relative, or sometimes the money comes from the child themselves, takes some money, typically after-tax dollars, that is not IRA dollars, and then contributes it to an account that grows income tax-free. And then, depending on when the child wants or needs to spend some money, and assuming that that money is withdrawn for a qualifying use, and the ABLE account qualifying uses are pretty liberal in terms of what a child can do with it. They can pay rent, they can pay food, they can pay for equipment, they could do, most normal expenses that a child with a disability would have. And the wonderful thing about it is it isn't considered a resource for SSI, so it gives the child some spending money, if you will, on things that would be a reasonable use for that money. And it grows tax-free. The problem with it is that you can't put in hundreds of thousands of dollars, or else, frankly, I would, because it's wonderful. It's also a little bit like a Roth IRA. You put in after-tax dollars, it grows tax-free, assuming, well, with a Roth, it doesn't have to be a qualifying use, but you take it out, it's tax-free. So to me, it's almost always something that is part of our recommendations. But that said, it doesn't tend to be a game changer.
So it's like a savings account.
That's exactly what it is. It's a tax-free savings account.
Do you get interest from that?
Oh, sure. Yeah, typically you're not going to get as many investment options as you would if you went to Vanguard or somewhere like that, or even as a 529 plan, but you should still do it. And it is a great source of money for your child. Again, if it's capped out at $170,000 and you're trying to provide for your child for the rest of their life, that alone it's going to be a good thing, but that's not the game changer. But it is something that we always recommend, and I have myself. And it's also a nice way for other relatives to contribute to the welfare of the child in a very tax efficient manner.
So to recap, so it is a savings account you can have for your child. that does not count towards income towards SSI that would disqualify them. And it's tax-free, and you can gain interest, and you can have up to $100,000 to $170,000 in there, and they can also spend it on living expenses. So that was a misconception that I had. I thought that ABLE accounts you could only use for like medical equipment and things like that. But you're saying that no, you can use that for rent, living expenses, all of those things.
Yes.
Wow, that's a pretty good deal, right? Like for somebody's thinking, I don't have a lot of money to put away, where can I start that can help?
It's a great start. And the other thing is maybe you put away some money in a 529 plan, hoping at some point that your child would be able to go to college and that you could use that. And there is a method of transferring the 529 to the ABLE. And also, it's very limited, but being able to transfer some Roth to the ABLE.
So if you have a college fund, for example, for a 529 college fund, and your child doesn't use it, you can transfer that to an ABLE account.
The short answer is, if you jump through some hoops, the answer is yes.
Okay, well, that's interesting information. What about health savings plans?
HSAs are wonderful. They're even better than a Roth. They're even better than an ABLE account. So with a regular retirement plan contribution like an IRA or a 401k, you put some money in a retirement plan, you get a tax deduction, it grows, and at a certain point somebody withdraws it and you have to pay tax not only on what you put in, but also on all the growth and dividends and interest, etc. when you withdraw the money. With a Roth IRA, assuming you meet the qualifications, you put money in, or a Roth 401k, you put money in tax-free, it grows, and eventually you take it out, assuming qualifying, it comes out tax-free. With an HSA, you get a tax deduction going in. So that's just as good as an IRA, and it's better than a Roth. But then when you take the money out for a qualifying medical expense, you don't have to pay taxes. So it's better than an IRA, it's better than a Roth IRA, it's better than an ABLE account. So I've been a big fan of HSAs forever. Again, the biggest problem with HSAs is that there's limitations on how much money you can put in and how much money you can accumulate. But that is a great thing.
So if you have access to a health savings plan, you should be using it.
Definitely.
Okay.
Definitely. The other thing is, who's kidding whom? You have to take care of yourself first, right? And typically what happens is, for example, the way I'm doing it is I'm putting in as much as I can, and I'm letting it build and build and build tax-free. And then presumably when I am older and I have medical expenses, I'll take it out tax-free. And ultimately, I'm going to pass more money to our daughter in a special needs trust, which we'll talk about later. But
yeah, and actually that is the next thing I was going to talk about. So in your book, you talk about special needs trusts for children with disabilities, which I had never heard of before. First of all, a lot of people don't even know that in your will, you should be not just willing something direct to your child. You should put it in a trust so that you can have them be the beneficiary. That's kind of a tax shelter. But you're saying that there's a special needs trust, and that's different. So how is that different than us just willing money to our children or putting it into a different type of trust and sending it to our children? How is that different?
I feel compelled to do a little bit of background on estate planning for a parent with a child with a disability. So first, I want to tell you how critical it is. Let's say that the estate attorney or the financial advisor or somebody who is helping a couple who have otherwise healthy children without a disability. And let's say that I screw it up. I didn't do a Roth when I should have. I did the paperwork wrong. I missed something. And a child ended up with $500,000 less than they would have otherwise. Now that's pretty horrible, right? Gee, the kid could have had $500,000 after mom and dad died, but instead, because the attorney botched it, they have nothing. That's terrible. But presumably, if that child is healthy and maybe they're an adult by the time I and my wife die, they'll be able to make a living. They'll be able to provide for themselves. Would it have been a lot better if they had an extra $500,000? Absolutely. So it's real bad, but it's not an absolute tragedy. Let's say that the child does have a disability, they're not able to work independently, and that they have to rely on the government and their parents' inheritance. And the advisor or the attorney or somebody botched it. So instead of having a $500,000 cushion or $500,000 more, they have nothing. That is a tragedy. Your kid running out of money during their lifetime is a tragedy. Nobody wants to have a broke kid that is just completely subject to the whim of the government and who knows what's going to happen in the future in the different states, et cetera, et cetera. It is mission critical to get this right. And the problem is so few people are getting it right. And again, qualifying for SSI and SSDI is number one. Getting your estate planning right, that is number two.
Let's just take a second to unpack that a little bit. So that is such a thing that I think so many parents with children with disabilities, our greatest anxiety, as you were saying earlier, is what will happen to my child when I'm not around, when I'm not there to take care of them, when I'm not there to manage all of the things. How is my child going to be able to survive if they can't work, if they can't do these things? And so that's one of the reasons why this subject is so important, right? Because it is a major stress point for parents. It's one of the number one stress points. So let's talk about the special needs stress.
Okay. Well, first I'll kind of go backwards a little bit and just talk a little bit about what a trust is, and then the difference between a regular trust and a special needs trust. Let's say, for discussion's sake, that you have no reason to believe that your child isn't anything other than, healthy, normal, will have a good, productive life, will be able to work, et cetera, and you're writing your will or your trust, and you might have, say, something like, in the event that my wife and I die before my child reaches age 30 or something like that, then I leave the money to a trust for that child. And the terms of the trust are the child gets the income, they get to write principal for health maintenance support and education. And then at particular ages, maybe a third at 30, a third at 35, a third at 40. And then at age 40, we release everything else. And that way that it protects the money from the child themselves. If the child does something stupid, it protects the money from creditors, including future ex-spouses or maybe an accident or whatever it is. And that's prudent. Now let's take the next step. Well, my child doesn't qualify for SSI or SSDI, but they do have some major problems, and I don't trust the child to make good financial decisions that will last his or her lifetime. So therefore, I'm not going to say, oh, by the way, the child can have the whole thing when they're 40. Maybe you keep that trust intact for the child's entire life. And we do that a lot with, particularly for maybe a child that has a drug problem or an alcohol problem, or sometimes people got caught up in other people taking advantage of them, and particularly if there's maybe a mental impairment. And we just don't want to leave it to chance that the child will make sure it's okay. And maybe whether there's a loving relative or even a bank, we name the loving relative preferably as the trustee, and they watch over the money. And let's just call that a standard protective trust that doesn't end when the child is 40. So why not just do that? And that's what I'm going to guess a bunch of your listeners already have. The problem with that will ruin the qualification for the government benefit because of income and because of net worth. So the child has a couple $100,000 in this trust. The trust is throwing off some income. And in addition, it's net worth that will be held against the child. So they might lose their qualification for the government benefit, or worse, they might have to give back some of the money that you left the child after you died. They have to give it back to the government because they now have money. So it's a terrible thing for a child who has a disability to be left with a standard creditor's trust.
Yeah, and I thought what was really interesting that I've heard a lot of families will do, especially with children who might have an intellectual disability that, like you said, may not be trusted with money. One of the things that you talk about is that a lot of people will put a relative or a sibling in charge to handle that trust. But that's a bad idea because you don't know after you die whether that sibling or that relative is going to do their due diligence. In fact, they sometimes take advantage of having that money and may not give it to your child. And so having that as a solution is kind of not the best solution, as rather than having your child be the beneficiary, right?
There's a little nuance there. What I really don't like, and I have seen in practice, is, so let's assume that you have one child that is able, one child that has a disability. So you say, okay, I trust the child that is able. I'm going to leave them all my money with the understanding, not the written understanding, but the oral understanding that they're going to use that money or half of the money for the benefit of the child with the disability. That way, the child with a disability can apply for benefits and can honestly say, I don't have any money of my own. And maybe that'll work out. All right. And maybe the child, typically a sibling, will be honorable, et cetera, et cetera. But by the way, maybe they're not. Let's take another case. So let's say, for discussion's sake, Crystal, you have two children. Let's say that one of them ends up being able to work and won't have a problem in terms of earning money, and they'll be financially responsible, and the other one does have a problem. So you say, okay, I'm going to leave everything to the one who is okay. And then they get married, then they get divorced. Uh-oh, there goes the money that you meant for the other child. What if they go bankrupt? What if they run over a football player's toe while they're driving and they get sued for millions of dollars? It's way too risky. So that's why I don't like just giving it the money to one child with the understanding that they're going to take care of their sibling. Now, by the way, I'll tell you, I have seen it work. So I'm not going to say never even consider it for 1 second, and it's never worked, because I'm guessing more times than not that it will.
But there are risks to it.
And the thing is, it's a risk that we can't afford to lose. Even if somebody did a study and they came out and said, hey, it's going to work 80% of the time, I'm not happy, because the 20% that it doesn't work, the stakes are so high. But if you have an honorable sibling that you trust, that person would probably be okay to be a trustee. It's not their money. And the trustee has relatively specific things that they can use the money for. That might work out better than naming a bank, just because they know the sibling and they say, oh, well, they're not a financial expert. Well, they can hire a financial expert. They can hire an estate attorney. They can hire somebody that could help them and pay them on an hourly basis, however it is done. And if that attorney, financial advisor, whomever, CPA doesn't do a good job, they can fire them and go somewhere else. If you name the bank as the trustee, you kind of given up a lot of your power. I'm not saying don't ever do it, because sometimes the siblings are ready to cut each other's throats, and it would just be a terrible thing. But it's typically not my first choice if we have a responsible, loving sibling who we think would do a good job.
So naming a sibling a trustee of the money instead of having it their money that they just give out to them. So having that set up so they're a trustee, but it's not actually their money.
Yes.
Okay, so that's good to know. So you're also saying, just to kind of clarify so that I understand, so a special needs trust is different because it doesn't go against their benefits for SSI, and it also allows them to have withdrawals throughout their life instead of limited, correct? Am I understanding that correctly?
Yes, but it's not a panacea. And the reason is, just like we were talking about, the able account is so liberal in what you're allowed to spend money for. If the money was considered the child's money, then the government could say no benefits. So it has to be drafted in such a way that it's very obvious that it's not the child's money. Where a protective trust, by the way, they would deem that to be the child's money and they would deny benefits or even try to get them back. So with the special needs trust, the attorney has to kind of get it just right. Well, the child can do this, this, and this, but they can't do this, this, and this. And, we have a lot of experience on what language works and what language doesn't. And it's not like the attorney's sitting there with a blank computer and says, well, I think I'm going to start writing. No, we all have form books and we use the form books that work. The problem, though, is you have to get that part just right. If the underlying asset is an IRA, we can get to that if we have time. You have to get 4 specific conditions. You have to get that right. And then there's going to be another nuance that I'm going to introduce. You have to get that right. So one of the problems, and it's a big problem, by the way, that parents of a child with a disability face is finding an appropriate attorney to draft these documents and to be able to trust that attorney. And to make it worse, the attorney has to be licensed in the state of the residence of the person drafting the will or the trust. So let's say that there's this, if you're fortunate enough to live in Pennsylvania, you could go to Julia Steinbacher, one of the co-authors, and she knows her stuff. I'll vouch for her personally. But if you live in the 49 other states, Julie isn't licensed in those other states. Now, she has some connections there, as I do, but finding the appropriate state attorney is not so easy.
So what should parents be looking for when they're looking for an attorney? Is there you need to be looking for certain certifications, or is there something specific where when they're going down the list of all the people in the area, what should they be looking for?
Well, the first piece of bad news, in my opinion, is subject to pretty rare exceptions. I would prefer the parent go to a specialist. Again, when I was doing my plan, we had an estate planning law firm, and we drafted 3,000 wills and trusts and beneficiary designations. And I think the attorney he now owns the firm, but who was then working for me, was fabulous. And I could have had it done for free. But no, I went to Julia Steinbacher because I knew that she would have more specific expertise than even this excellent estate attorney that could have done it for free. Maybe you'll get lucky and maybe the estate attorney will do a good job, but it's very hard to get everything just right. And to me, I want somebody who's done 10, 20, 100 of these, never did one or one or two, and they're floundering in a form book that they don't understand. The other thing is, if somebody has done this for a long time, they are probably going to be in a better position to advise the trustee and beneficiaries after you're gone. So, or their firm is, because usually if a firm takes on this specialty, and it's a big deal for a firm to take on. You don't just wake up on one day and say, oh, okay, I think I'm going to go into this specialty. I'll spend 5 hours a week for a month reading about this. No, this is a big deal if you're going to take this on. That's the kind of person who I typically want, because even a lot of things that are not all that problematic for preparing a will and a trust for a child who is healthy, even just things like guardianship provision, that's pretty intense stuff. And I don't want somebody who's never prepared a guardianship provision for a child with a disability to do that. I want somebody who's done 10, 20, 50, 100.
So if I would Google estate attorneys that specialize in special needs, what would I look up?
That's a good start. I'm a little bit biased, but I tend to like people who are at the top of their field, and people at their top of their field tend to want to teach. So they write books, they write articles, they give workshops for other attorneys. I mean, that's not to say that there isn't somebody in a little dinky town somewhere who knows all of it and he doesn't write, and he doesn't publish, and he doesn't teach. Yeah, they could be, but then it's really hard to find. And then how do you distinguish? But if you have people who've written for peer-reviewed journals, and it sounds self-serving because I have, I've been teaching for 30 years to financial advisors, CPAs, attorneys, and I've written, 10 books and many, many articles. But to me, somebody who has written, and particularly in a peer-reviewed journal, so if you go to a respected magazine, they're going to have people, frankly, who are going to look at your article and they're going to try to chop it up and look for mistakes. That's a good start.
Okay, interesting.
Now I'm going to give you some advice that most estate attorneys don't know about. And Crystal, I'm going to use you as an example. So let's assume for discussion's sake, and you're doing your will right now. And let's say that you're saying, well, gee, I'm hoping that when they're 18, that they're going to qualify for SSI or SSDI, but maybe they won't. Maybe the government will change their standard. Maybe they'll improve in certain areas, whether it's their hearing or other potential impairments. And you just don't know. And frankly, that's the way a lot of parents are. There's some people that are very obviously will qualify. And then there's people who will pretty obviously won't qualify. But there's a lot of people that frankly could go either way, and it might change between the time that you're doing your will and the time that you die. Meaning one possibility is you assume that your child's going to qualify and you do a will based on that with this special needs trust. And then the child improves, doesn't qualify for benefits. And now the money's left to this special needs trust, which, if you remember, is much more restrictive in what it can do to help the child. Well, that's not good. So if you guess, yes, my child will need a special needs trust, it turns out that they didn't, and what they should have had is a protective trust, then that's not great. All right, let's go the other way. Oh, I don't think my child will ever qualify, so therefore I'll just do a plain old protective trust. And it turns out your child did qualify. Now you have a trust that doesn't protect government benefits. So this is the quandary that a lot of parents have. Here is what I think is a great solution, and it's called the toggle. And what the toggle does is you're essentially drafting two trusts. One is, I'm explaining this conceptually, not mechanically. One is what I'll call a traditional protective trust. One is a special needs trust, and you let the trustee decide, not now, but after you're gone, what trust they need. Oh, the child doesn't qualify for SSI, doesn't look like they ever will, so we're just going to use the regular protective trust. Toggle to protective trust. Example number 2, oh, the child has, since mom and dad did their will, or maybe the child qualified before, they still qualify. Okay, now we're going to do the special needs trust. So they, in effect, push the special needs button. That is a not well-known strategy, but it's something that I really like and really believe in for a lot of parents who they just don't know how their kid is going to turn out.
Just to kind of make sure I understand this correctly. So you're saying that when you go to your estate attorney, you can ask them to draw up both trusts. And then depending on what the rules are and where your child is at the time of your death, then they can switch back and forth based on if your child qualifies or if they don't. So you're drawing up both ones and then deciding later which one will be the best option. Is that correct?
That's correct.
Okay.
And very, very few people have that.
Interesting. So let's get into what your specialty is, which is the retirement accounts and turning a retirement accounts, willing them to your children in a way that they can have access to money. Well, first of all, let's talk about the different types of retirement accounts and how we can use that to our benefit in order to help our children.
Okay, sure. Well, a traditional IRA, and you asked me to include other retirement accounts, so I'll broaden the question. Your IRA, your 401k, your 403b, your SEP, your TIO, your, let's call it traditional retirement plan, either you or an employer or both put money into a retirement plan, you're not paying taxes on that contribution. So let's keep it simple. You put in $5,000 in a plan, you get a tax deduction. If it is withheld from your paycheck, that $5,000 is, let's say that goes to a traditional 401k, is not taxed, which is one of the reasons, by the way, a lot of times when you get your W-2, your state wages and your federal wages are different. Your federal wages are often lower because the retirement plan wasn't taxed for the Fed, but it was for the state. Then that money presumably grows and is invested until retirement or minimum required distribution. You take that money out and you get this tax deferral. That is, you weren't paying taxes every year on the income, on the dividends, on the capital gains. But ultimately, you have to take it out and pay taxes. And by the way, dying doesn't help the problem, because then, unless you leave it to a charity, the beneficiary, including a special needs trust, is going to have to pay taxes. Okay? So that's income tax. All right, example number 2, you or an employer put money into a Roth IRA, 401k, 403b, etc. You don't get a tax deduction, but the money's grown income tax free. Then when you take that out, and by the way, as a bonus, there's no minimum required distribution on a Roth like there is for a traditional retirement plan. When you take it out, assuming that you're not violating one of the conditions, like it has to be in there for 5 years, it's income tax free. So then the question becomes, well, which one is better? And, I am an attorney, so I'll always answer a question like that is it depends. But I'll try to be useful also, unlike attorneys, and say that generally the Roth is going to be better. If you have a child with a disability, the Roth is going to be much, much better. And a large section of the book is devoted to Roth contributions and Roth conversions. And one of the ways that my wife and I got a huge start that accounts for a good chunk of the $1.9 million in today's dollars that our child will have instead of being broke is because we were very aggressive with Roth IRA conversions. And we actually made a $250,000 Roth conversion in 1998. That was everything we had, by the way, in our retirement plans at the time. And that alone will probably make it so our child is better off by close to $1 million. Just that one $250,000 conversion. Now, to be fair, I did it the first year you were allowed to do it, and I was on top of it. And then I did write the first peer review article for Roth IRA conversions. But when you run the numbers, even for people with a child who doesn't have a disability, in most cases, the Roth is going to be superior to the traditional retirement plan.
So when you say conversions, that's basically going to your estate planning or your accountant and saying, I want to take the money from my other retirement accounts and I'm going to put it in a Roth IRA. Is that correct?
Right. So
okay.
To me, the issue of converting from a traditional IRA to a Roth IRA, how much should you convert? What year should you convert? Should you do multiple year conversions? What's going on with the rest of your income? What's going on? Is the child able, or is the child going to qualify for SSI or SSDI? And I can get into why that's so different. But the Roth IRA conversion, it's not a matter of opinion, it's math. Yes, you can argue about what assumptions you're going to use, but assuming that you have some reasonable assumptions that you can live with, the question of how much and when to convert becomes a matter of math. And people always want to say, oh, well, my situation is different. And it's a matter of math. And you can say, oh, okay, if you do nothing, you're here. If you do some, you're here. If you do more, you're here. If you do too much, it's not optimized. So you really want to get this right. And, I'm not saying that people can't do it on their own, and CPAs tend to be better at this than attorneys or financial advisors. But again, it's a math problem.
Okay, so then with your Roth IRA, you can will that to your children. Is that correct?
Mhm.
Where would that money go? So would it go into the special needs trust?
Well, by the way, this would not be controlled by your will. It would be controlled by the beneficiary designation of the Roth IRA.
Okay.
And that's mission critical. Typically, what I would do is I would name the surviving spouse as the primary, and then I might do this toggle trust as the contingent. And then the trustee says, okay, the child qualifies for SSI. We're going to toggle it to a special needs trust. So now you have, and the technical word for it is an inherited Roth IRA that is now in the hands of a trustee who's going to use that money to benefit the child. And the fact that the Roth IRA grows income tax free does not change after death. So your Roth IRA that was growing tax free while you were alive continues to grow income tax free after you're gone.
Wow. Okay.
All right, but that's not the really big news. The really big news is that under the old rules before 2020, let's forget about disability for a minute. And let's just say that you named a kid who was 40 years old at your death. And let's say there was $1 million in either an IRA or a Roth IRA. Well, the last thing, particularly an IRA, the last thing you want to do is take that $1 million out and pay taxes on it. That would be horrendous. You want to take out what's called the minimum, which is the minimum required distribution of the inherited IRA, which is taxable, or the minimum required distribution of the inherited Roth IRA, which is tax-free. Well, in 2020, they said subject to exceptions, all that money in the IRA, the inherited IRA, or in the inherited Roth IRA, that all has to come out within 10 years of the year following the death of the IRA. Where the old rule was the beneficiary could stretch that inherited IRA, or better yet, the inherited Roth IRA, for their entire life. One of the exceptions was this special needs trust. My mantra, if you will, is pay taxes later. I want your kids to pay taxes on that inherited IRA, particularly if it's a child with a special needs, over their entire lifetime. And the difference between leaving them $1 million in a trust that qualifies to be distributed over their lifetime versus one that they have to pay the taxes in 10 years, that additional tax deferral, that alone can be worth close to $1 million.
Okay, so that's where this whole your IRA, retirement, and the special needs trust kind of connect here, is that if you have both, you can basically say like, okay, Uncle Sam, we're gonna limit the amount of money that you're gonna take, and my child's gonna get the most amount that is allowed.
Right. And if it's
Correct?
a Roth, then that money's coming out gradually over the life of the child, but it's coming out tax free.
Okay, so that's a big difference.
It's
Yeah.
a very big difference because trusts have the highest tax rates there are. So again, all these things make an enormous difference. And for all the work that I do, if I could only do one piece of advice, it would be running the numbers and developing a long-term Roth IRA conversion strategy.
We've been talking for a long time, so I want to kind of wrap all this up. You talk about you have 3 critical things that parents should be doing. So what are those 3 things, and where should they start? Like if you're today listening to this, you didn't know any of this information, and we want to get started.
Okay, if your child is 18, go SSI, SSDI. If they are not, or even if they are, next step, get your estate plan right. Wills, trust, special needs trust, the whole bit. Then after that, and of course some of this can be done simultaneous, get the planning right with the Roth conversions, the ABLE accounts. And here's the thing, in my world, learning is change of behavior. So you've done a great job of absorbing a lot of the information in the book. Well, to me, that's nice, but what's really nice is if you go and do something about it. But if I could put in a plug for free resources. So our book It's called Retire Secure for Parents of a Child with a Disability. And again, this is my life passion. I am not here to sell the book. Good news. I'm here to give away the book. I would be happy if every person who heard this, both now and then in the future, I would like everybody to take advantage of the offer to get a digital copy of this book for free. And I want you to do that. And then, as Crystal said, I want you to look at the table of contents. Okay? So you would go to disabledchildplanning.com/podcast. disabledchildplanning.com/podcast. That will take you, and we will email you the book. I think it's the best resource there is for parents of a child with a disability on the financial side. Now, depending on when this airs, we are having a summit on June 18, 19, and 20. And we are having the 3 authors speak. We're having Tatiana McFadden, who is probably the top celebrity athlete with a disability. She'll be speaking. We have a bunch of other content experts. And then it's going to be very easy. You can pick and choose which speakers you want to hear about. Again, it is free. It's virtual. You can, listen from or watch from your living room. And it's June 18, 19, and 20. And for your convenience, I have the same website where you can get the book. You can sign up for the webinar.
Okay, great. So I'm actually going to have that link in the description of the podcast. So if you are listening to this and you want a free copy of the book, and if you are listening to this before June, what was the dates again?
18, 19, and 20.
Okay, so and that is in year 2024. So,
that's correct.
So if you're listening to this before then and you want to sign up for the free, we will have that link in the description. So go to the description. I will put a link right there so you can just click on it and it will take you right to his site. I'm going to tell you both as a person, like I said, who does not understand finances, this book is worth having, even if it's just a reference, even if you feel like, okay, I can't sit down and read this whole thing, fine. It's got a great table of contents. You can pick and choose what you're ready to deal with, because some of our parents might not be ready to dive into everything, but maybe you're only ready for starting an ABLE account. That's fine. But you can go into this book. It'll give you instructions. It gives really nice stories. It's written by people who understand why this is so important. So click on the link. And thank you so much, James, for being here. I appreciate all the information, and we will be in touch. But I'm super excited about all this, and hopefully everybody else is. So
thank you, Crystal.
If you're just tuning in for the first time to my podcast, I encourage you to go back and listen to some of my previous episodes from last season, where we discuss an array of topics from all different perspectives. Don't forget to like and subscribe to my channel. And if you really like my podcast, check out my Facebook and Instagram pages, and of course, share with your friends. Also, check out my YouTube channel, where I have the first 3 episodes of the podcast interpreted into American Sign Language, and will be continuing to add more as time goes on. Stay tuned for future episodes coming out, but until next time, I'm signing off.